Good afternoon. Today is Monday, June 5th. I'm Joe Terril, President of Terril and Company, private wealth managers headquartered in St. Louis, Missouri, with approximately $700 million in discretionary assets under management. This is a video update of our recent thoughts on the economy and the investment markets. Starting with the economy, we have been saying for the last few months of last year and every month of this year, we believe the economy will stay strong and we will not have a recession in 2023. We see nothing in the recent economic news to discourage us from that belief, and we saw employment figures Friday that actually reinforce that belief that the 2/3 of the economy that the consumer is responsible for is doing fine. Consumers are spending money, the consumers are working, they're getting pay increases, and this 2/3 of the economy is just fine. The 1/3 of the economy that is business spending, businesses were quick to cut back in anticipation that the consumer was going to stop spending, the consumer would be priced out, etc. That hasn't happened yet. We believe that businesses will go back to spending more money to satisfy the needs, wants, and desires of the consumers who ultimately they manufacture products and take care of. So the higher interest rates have not devastated the housing industry, have not devastated the auto industry. If anything, both of those industries are doing just fine right now. You're not seeing a lot of refinancing going on in housing. People are sticking with the incredibly cheap interest rates that they have locked in. But new housing is doing okay. If they can afford a 6.5% mortgage payment, they're doing it. Realtors are reporting you've got a good house at a good price, you'll get multiple offers. Auto manufacturers are reporting we have good demand for new cars, even at some of the incredibly high prices for them. So that's our belief on the economy, that it's going to continue to stay strong. It's not going to grow at 4 or 5%, but can we get 2-3% continued growth in the economy in the United States? Absolutely. Economies around the world in Europe, a little bit of a different story. China, hard to get the truth out of China, hard to get the figures, but we expect that economy to be improving, and the reopening, if you will, of China to continue to help the overall world economy. Investment markets have interestingly made a complete return to 2021, 2022. On the stock side, you're back to having 7 or 8 high-tech stocks dominate the overall averages. You have 2 stock markets out there right now. You have the stock market for those glamour high-tech stocks and then everything else. We are finding bargains in everything else. Basic industry companies that make chemicals, that make paper, the banking industry, the insurance industry, fertilizer, steel. These companies have continued to come down all year long, and they are now entering levels where they're good investments at these prices. The high-tech glamour stocks, it's going to end badly. People that jumped on those momentum trades, the computer programs that drive a lot of that investment momentum were down 30% or more when it finally broke in 2022. Same thing will ultimately happen right now. There's no bargains in that area, and it will end badly. We expect interest rates to stay at these levels or maybe even move higher. The prognosticators out there that believe the Fed will be cutting interest rates later this year, we think they're going to be completely wrong about that. One of the things that we like to point out right now is the Federal Reserve Bank is not tight on credit. There was a time frame in the days of Alan Greenspan or Volcker where when they wanted to be tight on credit, they removed reserves from the banking system. Interest rates went to whatever level was necessary when the reserves were removed. If you go back and look at some of our podcasts from 6-7 months ago, we were talking about this very item. This is the first time in history that the Federal Reserve Bank intends, and they are leaving all the reserves in the banking system. In simple English, that 40% or more growth in money supply that came about by printed money that caused higher inflation, and they did that because of COVID. They're not removing those reserves out of the banking system. They're trying to raise interest rates right now to 5.5% to discourage people from using those reserves. It's not working. Speculation, whether it's on daily stock options that only have a 24-hour termination to them, or the biggest evidence we see there is everybody's back to speculating on a few high-tech stocks. You can have all the reserves you want if you'll pay the price. This is the big difference between the way tightening was handled in the past by Federal Reserve Bank governors, chairmen, chairpersons, etc. So this is why we think interest rates are going to have to move higher. 5.5% is not discouraging anyone. So we think by the end of the year, the surprise is interest rates will be going up more, not down as many people think. Consequently, this will have a dampening effect of some sort on the speculators in the stock market. We see no reason to extend maturities in the bond market. There are people that believe if you don't go out and lock money up right now for 10 or 15 years, you're going to be sorry because interest rates are going back to 2 or 3%. Our one-word response to that is nonsense. That's not going to occur. We think with fixed income, you keep durations incredibly short. As our paper matures, we'll be reinvesting it at the same interest rates levels or higher. So that's a update. Thank you, Brian Curtis, for helping us produce our podcast. We'll be back in 2 or 3 weeks or as needed with another update. Thank you for watching.